Hello, everyone, and welcome to today's Blockworks webinar, The Intersection of Crypto and Finance. Today's episode is made possible by LMAX Digital. I'd like to invite our speakers to unmute their lines and turn on video. During the webinar, please submit your questions to our speakers using the Q&A function at the bottom of your screen. We'll save some time at the end of the discussion to answer these. The session will be available on demand, and all registrants will receive an email once the recording is live. I'd now like to turn the event over to Blockworks co-founder, Mike Ippolito. Mike, please go ahead.
Awesome. Thanks, Jane. There's nothing like a little bit of Matchbox 20 to get everyone excited and pumped, talking about the intersection of crypto and traditional finance. I want to dive right into it here. We've got a lot of ground to cover, but I do want to give a quick shout out to LMAX Digital for making this possible. Thank you very much, LMAX. For those of you who don't know, LMAX Digital is the institutional crypto exchange, which is operated by the broader LMAX group. They have robust technology, liquidity, a whole bunch of interesting stuff. If you're an institution in this space and looking for an exchange, I highly recommend you go check them out. And with that, maybe we could actually do a super quick round of intros. Jenna, I'll actually pick on you to go first here. I know we usually have David on these things, so I'm excited to be doing this with you. You're the managing director. You've helped build this business. Talk to us a little bit about LMAX and what you do there.
Hi, everyone. Jenna, Wright from LMAX Digital. Thank you very much for having me today. Yep, as you said, David's let me out the box today and put me at the forefront. So I'm very excited about being part of the panel and letting you know what we're doing here at LMAX Digital. So as you said, LMAX Group runs 5 exchanges globally, typically and traditionally on the FX side. More recently in 2018, we launched LMAX Digital, which is solely focused on institutional crypto trading. So that's us in a nutshell, and I look forward to talking a bit more about what we do as the webinar goes on this evening.
Awesome. Thanks, Jenna. Just in order on my screen here, Pomp, you want to go next?
Yeah, Anthony Pompliano. Most people probably know me as Pomp, and do a bunch of investing in the industry, and also create a bunch of content as well.
Awesome, thanks. Last but not least, Mr. Jay Biancamano.
Thank you, Jay Biancamano, State Street Digital. Who would imagine that would have been a term we could talk about 2 years ago? So State Street Digital, we've been here for probably a little over 4 years, looking at crypto, blockchain, digital assets, and I'm very excited that the firm is moving that direction, and I think we have a lot of exciting things ahead of us, working with people like yourselves. So appreciate being here. Thank you.
Awesome, guys. And thank you all so much for being here. I'm super excited to just dive right in here. So I guess starting from like a pretty high level, like if you looked at the Venn diagram, kind of financial services over here, crypto and digital assets over here, we've kind of been moving closer and closer together, and those two circles are starting to bump up. So what I'd love to, just as a jumping off point, when you see those kind of circles coming together, where are we first starting to see overlap, just in terms of institutions that are getting involved, infrastructure that's necessary? What's your general framework for seeing how those two different worlds kind of come together?
I'll dive straight in on that one. I think for us at LMAX Digital, the convergence of FX and crypto is real. If we look at the stats, 45% of LMAX Digital clients actually already trade FX with LMAX Group. So it's happening. We're seeing it every day, and really it's the institutional customer. When we started thinking about LMAX Digital, actually this was a 2017 conversation. Our top FX guys came knocking on the door and said, "Hey, you guys, we're doing a fair amount in crypto now. We're trading on all these retail exchanges. How do we access institutional grade infrastructure? What you do in FX and crypto, can't you just do it for us?" And then very quickly, when we started looking at the mechanics, how easy is this to do? It's the same software for us. It's just running an additional exchange number 5 from the 4 we ran previously. Obviously, granted, there was a bit of blockchain tech we had to go and look at and understand. We had to learn how to code to some of the blockchains in order to store the crypto. We'd never done that part before, but once we put it all together, in 6 months from that conversation, we had LMAX Digital off the ground, and we were good to go. And look, it's the same desks, it's the same trading styles, it's the same guys, whether it's FX or crypto, it's just another asset class. These guys want to make markets in anything really where there's fat to be made, and that's I think for us the biggest crossover we see.
So let me piggyback on a little what Jenna said. I think it really comes down to servicing the institutional market, right? So the institutional market, we've seen coming closer in that concentric circle. So if you think about the conversations we've had, 2 or 3 years ago, it really wasn't around facilitating crypto. It was really around blockchain, what we could do in blockchain. Now it's facilitating crypto. And, we've seen the institutional market looking more closely at this. If you were to look at our constituency, we kind of have a different constituency or a different value proposition here at State Street than what Jenna's talking about. We have to demarcate between what's digital and what's traditional, for lack of a better word. So because it's different, custody, we're a custody bank. Traditional custody and digital custody are two different beasts. However, when you think about when we need the service, right? Institutional clients want to have the same type of service. So we have to try and create those concentric circles and not actually just overlap, but actually fit them over each other and provide service around that. So the conversation certainly we've been having with the early adopters are actually buying into crypto, certainly Bitcoin and Ethereum, but also working with our clients that are issuers of assets. And you probably are well aware that we're going to be facilitating the Van Eck Bitcoin ETF, as well as several others globally. And for us, it's really, is the convergence happening in the back and middle office as well as the front office? Yes, we have to actually look at the entire ecosystem here. And it's not just a matter of servicing an asset, it's actually creating a facility for institutions to get that experience that they have in traditional space into the digital space and do so seamlessly.
I think they really nailed kind of the two perspectives. The only thing I would add is it feels like there's a psychological or social kind of revolution that's taken hold now, where in 2017 and prior, people didn't care. Then from 2017 to maybe 2020, everyone looked at this as a highly speculative thing, like the crazy people on the internet did it. And now what you've gotten is the psychological kind of agreement or social consensus around, look, these assets aren't going anywhere. They're going to be important. And that is true from retail all the way up to the institutions. And what you're starting to see from institutions is they have to, one, have a strategy, but two is they're all trying to figure out how to play in the industry. And what you end up finding is there's actually very few institutions that like to take directional, like security selection type bets and basically take a position and say, hey, I think, A, B, or C asset is going to outperform the rest. Instead, what you see is them saying, well, what do we do in our legacy business? We provide rails, we provide infrastructure, we provide kind of gateways and somewhat toll booths, if you will. And we want to bet on the industry. We don't want to bet on individual assets. And I think that's really a key thing is the narrative has shifted, where people thought that institutions were going to come in and just buy a single asset. Now, what I think people are realizing is, no, these people are going to come in, they're going to build all of that infrastructure that's necessary. And if they're making the right industry bet, they're likely to, one, to do well financially, but also two is there's a self-fulfilling element to this, where one institution comes in, builds something they need, then another one comes in, they build something, and it kind of builds on top of itself. And you get a whole kind of industry once you look back, 10 years from now or so.
Yeah, I think one thing that's worth diving into here is who in crypto, we kind of refer to institutions as this homogenous group, right? And the truth is that they're not. They're actually very different entities with very different goals and organizations, et cetera. And, on the extreme side of things, some folks in crypto, like the institutions are here, look around. But we had, the CEO of Wisdom Tree at our DAS event last week is like the institutions aren't even close, right? So when you talk about some of the earlier adopters on the institutional side, Jenna, to your point, there's FX traders, right? Moved in, I think, very quickly. A lot of prop traders, right? Kind of based out of Chicago, they came in too, VCs, et cetera. So there certainly are like certain types of institutions here, but there are definitely like larger institutions, kind of the BlackRocks and Vanguards of the world that are still not close to this space yet. So how do you guys kind of segment the different institutions that might already be here versus who are the ones that we're still waiting on, and what are they waiting for?
Well, it's exactly that, right? The real money hasn't entered the space today because we still have a number of issues to face. There are roadblocks in the way. So from my traders, bearing in mind I don't face retail guys, my traders are HFTs and proprietary trading firms. They're making up the bulk of what we do on a daily basis. We've got to overcome the hurdles for your funds, your pensions, your asset managers to enter the space. Even your large corporations and banks, they're not going to trade whilst there's no credit element to, and you've heard this before, Mike, but at LMAX, we talk about ABC, we talk about market access, we talk about banking, and we talk about credit. Market access today, it's fragmented, it's very retail driven. It's 24/7 access for you and I to go and buy some Bitcoin. It's not set up for real institutions to come and get this efficient market access, this frictionless access that we need. Banking, okay, that doesn't necessarily mean about banks trading. We want them to trade, but more importantly, the household name banks aren't banking me. I can't get LMAX Digital onboarded with a true bank to look after my regulated institutional crypto exchange. It's just not a thing. And just as much for me, the crypto native funds, the asset managers, they need to bank with the sizable balance sheets. It needs to be bigger and better. And until it is, we can't get these guys in. And finally, the C part, the credit, they're used to credit mechanisms, prime brokers in FX. They're used to access points into traditional markets that we just haven't worked it out yet. It's coming. People are talking about it. A lot of references to being PBs in the space. Look, I think given that we've traded FX for a while now, we understand how credit works. There's still a gap, and at the point that we can get over that, we're good. And it really opens up the floodworks. And at that point, how big does the market become? If a pension fund can allocate 5% to crypto, where does Bitcoin go from there? I mean, look, I'm just an exchange. I match buyers and sellers. Pomp's probably got a better opinion on where Bitcoin goes from here when that happens. But holistically, I agree with the BlackRocks of the world who are saying to you, look, institutions haven't even started yet.
Yeah. So let me kind of add on to that. See, I think one of the problems in every market is it's never built for an institution, right? And I come from a background at ITJ and Liquidnet where we addressed institutional problems, certainly problems of liquidity. And Pomp also hit another issue in the market is that's a strategy. If tomorrow, in a perfect world, the regulators come up and they say, hey, listen, you know what, you guys can invest in crypto. It doesn't mean people are going to start buying and selling crypto, right? It doesn't mean asset managers are going to actually start modeling into the portfolio. They're going to need insights. They're going to need ideas, right? It's not a matter of putting Bitcoin. It might be a matter of putting something else into a portfolio. So I really think the strategy behind what asset managers need to do has to be fleshed out first. How do you incorporate that, right, Jenna? Putting 5% in a portfolio is great, and we know what it'll do to the market. So it's probably not going to happen until you have an asset manager that understands how to grab alpha in the market and how to access that market. I believe, up until last year, I knew this number was 60% of crypto was done over the counter, and I don't think it's moved that much. I just think there's a lot more of liquidity in markets, but really, the ability to satiate institutional demand is just not there yet. And I think markets really have to mature a little more for crypto to be to the point where institutions can access it in the way that they do traditional markets right now. Now, getting to the strategy piece, I think that's kind of a green field. I really do think that there is an abundance of information and insight that asset managers just haven't tapped into yet. And I think there's an opportunity for a lot of firms such as ourselves to provide that insight to allow them to do portfolio modeling and incorporate a strategy of crypto when and if that happens when the regulators allow it.
Yeah. I think, well, I was actually, this is going to kind of segue to my next question, but Pomp, I know you just came off a live stream actually with Brian Armstrong, right? CEO at Coinbase. For those of you who don't know, there's been certainly some back and forth between Coinbase and the SEC. Gary Gensler has been kind of, for lack of a better term, kind of like stomping his feet. I know Coinbase retired their Lend product. That's like the last big hurdle that I think many of us who've been in this industry for a long time saw coming, right? This was never going to be a totally unregulated space, right? And that was always a factor that you should have been thinking about. What's your kind of current thoughts on where the regulatory landscape looks like today versus where you think it's going, maybe?
Yeah. I mean, there's a couple of different perspectives you can take, right? The first one is crypto is the most regulated industry in the world. And what I mean by that is today in the financial capital of the world in New York City, if I want to start a traditional financial firm, I have to go through a bunch of regulatory kind of hurdles. I've got to get a bunch of licenses, et cetera. If I want to start a crypto company, I have to do all of the exact same things. Plus I have to get a special license, this BIT license, and that BIT license has only been given out to a handful of folks. And so it's literally harder in the financial capital of the world to start a crypto company than it is a traditional financial company. The second thing is the treatment of the assets. So if I go to dinner tonight and I want to buy dinner, I pay for the dinner, I pay my sales tax, and I'm done. If I buy it in dollars. If I buy that exact same dinner in Bitcoin, I end up paying for the dinner, I pay my sales tax, and I pay capital gains tax on the assets. It's not seen as a currency, it's seen as a property. So when you look at it, whether it's the tax regime or some of the regulatory stuff, it's actually more regulated than others. Now, with that said, you could argue that the regulation that is existing today, it doesn't necessarily that we're going to remove regulation. I don't think anyone thinks that's going to happen, but we need to shift the focus from things like the tax regime of treating a digital currency like a property, and instead maybe spend more of our time trying to figure out things like what's a systemic risk? What should the rules be? How should we actually look at some of these assets? Are they securities? Are they not securities? Like that to me feels like the more sophisticated conversation. And so what I think is it's less about like, there was no regulation, now there's regulation. And it's more so there's a shifting aperture of what regulatory bodies were focused on previously to now focusing probably on what's like actually the more meaningful material stuff, right? Like we need to figure out how do you treat a decentralized protocol if the rules are written for two parties in a transaction to be reporting compliant human-based organizations. I don't know what the answer is. And like, that's the crazy part is even the participants in the market are kind of saying to themselves, hey, this stuff's like pretty new and pretty like on the fringe. Like, I don't know if there's the right answer. Like, let's all figure it out together. And we're going to need everyone. We're going to need everyone from retail investors. We're going to need entrepreneurs. We're going to need investors. We're going to need regulators at the table. And we're also going to need institutions at the table. Like every single market participant is going to have to participate here because if they don't, what's likely to happen is those that write the rules write them for themselves. Right. And you know, take the institutional perspective. Like if the institutions aren't at the table helping to shape the rules, like you probably don't want to be an institution in this space moving forward because it's probably going to be pretty onerous. And so I think that's kind of just like what's happening is more of a shift to the more material stuff than, you know, stuff in the past that's just been kind of headline grab.
I guess like open question to the team here. Like, I'm not sure how closely folks have been following these developments. There's been some particular focus that gets paid to certain sectors of crypto, like DeFi and stablecoins have certainly attracted a lot of attention. And I feel like there's kind of two motivations, one that gets said a lot and one that maybe is less said a little bit. And, you know, if you listen to what Gary Gensler says, this is all done under the guise of kind of investor protection, right? That's the SEC's sort of mandate. They want to protect the retail investors. There's like pump and dump schemes, et cetera, right? And we can all agree to some degree that's merited. Then there's kind of the less said thing, right? Which is especially maybe one of the reasons why stablecoins are under particular focus and the Treasury is so interested in them is because it kind of undermines a very important political tool with the US being the issuer of the reserve currency, right? And we protect that system of issuance and control over dollars on a global scale very, very closely. So when you guys are looking at this regulation, how much of it is you think being informed by that kind of look? We got to make sure crypto's the Wild West. Eventually, we got to like rein it in and make sure people aren't like YOLOing their life savings into things. Versus, there actually is a very real shift in a power dynamic here that's happening on like a national scale. I mean, how do you guys view the ultimate drivers of this regulation? What's going on?
Look, for me, regulation is important, whatever way we look at it, on the retail side or more on the institutional side, you know, around treasury issues. We have to wise up a little bit. The market has to become a bit more regulated. There needs to be some clarity, because how are the institutions going to enter the space if every day the hot topic off the press is what the next one says about regulation today? We just need to get better. You know, from my point of view, we're almost horizon scanning regulatory implications every day of the week, because what's coming out, what's going on next. You know, we're heavily regulated as a group across asset classes and jurisdictions. It just needs to happen for the market to mature.
And I think for the most part, regulators are very open to this technology. And you know, let's bucket crypto and you know the digital asset space and just look at the blockchain itself. And you know, regulators, I think, understand the potential, right? They're very clear on potential. If you look at all of them, they've develop working groups and develop sandboxes to allow for experimentation and innovation. So the technology is not suspect. It really comes down to how the technology is used. And like Pomp said, it comes down to customer protection. Like every conversation we have is around customer protection. And if you listen to Gary Gensler talking about ETFs in the US, which we're very close to, it really comes down to 3 years ago, one of the reasons there was skepticism about an ETF was about liquidity. It was about protection of the assets. And I think two things have happened. One is technology has caught up to protection of the assets, and I think they have to understand that. And they have to understand blockchain and how that works and how they protect assets now at these custodians and how we can protect the assets. And then it comes down to liquidity, protecting the end consumer. And I think one of the good things that happened, in the last few months is actually you saw the break in the market in July. And people have always wondered about systemic risk in the market. And I think it proved that there's sustainable liquidity and sustainable participation out there, that regulators should become comfortable with liquidity in the market and how we can sustain that digital ecosystem going forward. So I don't see. I do think obviously the what we're hearing lately from Washington, certainly from Gary, is there's skepticism still. But I think that skepticism is something that's going to be overcome by both technology and just seeing how the market participants, how the market plays out and how participants are able to help that market play out in the direction they want it to.
The other thing I'll add to that, I think they nailed it, is there's this weird element of if you take the legacy system and you bifurcate it to those that are forward-thinking, innovative, technology, kind of embracing organizations. And then the other group is the folks that, essentially try to use regulatory capture and just hold on to the good thing they got going on. One of the areas that has the biggest regulatory-driven moats in the world is finance, and especially inside the United States. And what I think we're watching here is these two organizations plus a whole bunch of others are very forward-thinking. They're very innovative. They constantly are looking at this saying, we're not going to sit around and wait for the government to protect our position in the market. Instead, what we're going to do is we're going to go serve our customers. We're going to do everything we can to make sure that they've got products that work, that keep them safe, that allow them to invest in the assets that they want. And that tends to be a winning strategy, in my opinion. But I do think that we have to call out the fact that there's a lot of organizations who are not like that. Usually they're the ones who are on the losing end of this competition, and they're the ones who are actively lobbying for the stopping of all this technology, of all the innovation. And one of the best examples, I think, is if you kind of boil down a very simplistic kind of picture, we have a regulatory body that is saying to folks, hey, we don't want you earning 5, 6, 7, 8, 9% interest on a stable coin. Instead, you should be using the legacy system where it's safe. And then in those legacy systems, the average yield on a deposit account is 0.03 or 0.04, 3 to 4 basis points of return. We're literally talking about, in some cases, 200, 300x higher in the crypto world than in the legacy world. Now, you can look at that a whole bunch of different ways, but at the end of the day, you got to ask yourself, are we regulating for the sake of regulating? And are we creating rules just to create rules? Or are we actually trying to serve the customers, right? Both LMAX and State Street are saying, hey, we're trying to serve our customers. I think what the regulators have to ask is, what do our customers want, right? And I always think back to kind of like the Uber example. There was a point where the city was fighting it, and Uber kind of very expertly said, look, okay, we'll show New Yorkers what it would be like without Uber. And they basically pulled up blank screens, and the government heard from people saying, hey, we want Uber, and now it's here. I think we're going to enter into that phase where, I don't know how many people exactly in America, 30, 40, 50 million people in America end up being involved in this industry in some form or fashion. It's just a really big group of people that I think it's going to be hard to kind of break the will of what they want to do, as long as they're not doing anything nefarious, malicious, et cetera. And I think the institutions are kind of a big piece of helping that. I joke all the time that it's one thing for the government organizations and regulators to regulate retail, right? They kind of don't have a voice. They don't have a lot of resources as a group, et cetera. It's a whole nother thing when you've got multi-billion-dollar businesses kind of playing the game, and they're there. They understand this. A lot of times they understand the rules in some cases better than regulators do. And so there's a dialogue. And that's the important part, is you get a balanced dialogue rather than just it's a one-way street. Hey, we tell you what to do. I do think that you need that healthy debate in order to get it. And I think that's one of Brian's points today, was that the debate is really important because that ultimately gets us to a better place.
Yeah. And I think the idea of, hearts and minds in general, for crypto is kind of unique in it as an industry in the devotion or enthusiasm or whatever of the participants. And at a certain level, I think that's a powerful that's a powerful force, especially for kind of the politicians and regulators who are surveying the space. I guess one question that I have for you guys, we touched on a Bitcoin ETF in general. This is, I've been in crypto for 4 years. It's been a topic at the forefront since I've been here. Basically, we keep hearing that it's right around the corner. Jay, you were kind of alluding to some of the reasons why it hasn't been approved, that like liquidity, kind of security and market manipulation concerns. Now we're talking about as kind of a 40 Act futures-based ETF that could be. How important do you guys think overall that a Bitcoin ETF is for institutional buyers, right? Like, is this actually something that's important at this point? Is Grayscale serving that? Are there other macro proxies like Coinbase, or how important is the introduction of a Bitcoin ETF, let alone speculating like when it's going to be approved, but how important is it?
So I'll say that first, very important to me, because that's what we do here. We'll be servicing a number of these ETFs, but I think it's really important for institutions as well. I mean, they're looking for both an established money manager and an established custodian to help protect those assets and allow them to enter those markets. So I think it's critical, certainly in the U.S. One thing I could say about regulators in the U.S., what gets their attention is that when something starts to move offshore and they want to keep things onshore, and we know that there have been crypto ETNs approved in Europe, certainly Germany. We know there's crypto ETFs trading in Canada, right? So they're there. So I think the ability for U.S. money managers to enter the market is critical for the approval of an ETF and participation. And I think that's one of the things, obviously, that we will be looking very closely at, certainly for the next 6 weeks, if not 6 months, because we know there's not just one or two out there, there's dozens. And they're not just Bitcoin ETFs, there's indexes, there's, Ethereum, Cardano, Solana, everything else out there. So I think, as the market, in order for the market to mature, in order for institutions to enter, it's critical for ETFs to be approved.
Look, on the flip side to that, from my side, we have enough on our plate trying to work out the spot crypto arena. So we're not going there for now.
Fair enough.
The only thing I'll add is it's the thing everyone loves to point to and yell and scream about, because it feels like the most egregious thing of how do we have a $1 trillion asset without an ETF. But I think it's also the easiest thing for regulators to point at, whether it's volatility, et cetera. And so in some weird way, there's been so much talk and conversation built up for so long that I think it may be anticlimactic, or maybe it'll actually live up to the hype, but it feels like all eyes are on that. And the part to me that's the more interesting aspect of the conversation, how many will they approve on day one? I doubt they're going to king make and say, hey, only one gets approved. So there's a big difference between approving 2 versus approving 20, and kind of how chaotic can that market get as everyone scrambles to get assets. But that's more the execution stuff I think will be important over time.
And that's a great point, because I raised that point, right, internally, to say, because we're servicing hopefully a number of them, and it really comes down to if you look at history, it's the indexes, the S&P indexes, and there's not just one, there's several, right? So there's not just one that's preeminent, and I think it comes down to what institutions are offering the better service. They're not going to be looking as closely as fees as they probably would, but it is going to be incumbent that there is a fair level of access to the buyers of these ETFs.
Yeah. I want to remind folks that are listening, in 15 minutes, we're going to start taking audience Q&A. So we got 3 very smart people. Make sure you get your questions in. I want to shift towards some more kind of forward-looking stuff with you guys. Another narrative that's been around for crypto in a long, long time is M&A is right around the corner, and we haven't really seen that happen yet. When I look forward towards financial services and crypto companies that, moving of the 2 circles and kind of squishing them closer together, I have to imagine, I start to just wonder what that combination sort of looks like, right? And I feel like M&A is kind of a big piece of that. How do you guys ultimately see these 2 very different kind of sets of companies coming together? Are there acquisitions made from one side or the other? Do they end up being competitive, complementary? Like, how do you guys see these 2 different sets of companies working together? Jay, you smiled, so you look like you had something to say, man.
I mean, it's critical, right? So if this was 2018 and evaluations were what they are now, you would see a ton of M&A activity. But I think the valuations have gone through the roof. But we actually invested in 2 crypto companies earlier this year, Luca and and Securrency, and I think we'll continue to invest. So I think you may not see acquisitions at this point, but you will see a lot of investment from traditionals into those types of entities. And certainly that's one of our focuses, is to invest in not only the technology, but the ability for us to roll out products and services that, quite frankly, we don't have the internal expertise to do. And that's like any other institution or incumbent out there. And then on the flip side, you talk about there's a lot of redundancies in the industry. And there was, certainly in 2019, there were a number of smaller M&As. Some firms just, did acqui-hire, just take the entire, staff of one firm into another. So, but I don't think that's going to happen. I do think your question about a traditional versus an acquisition by a new startup. I mean, you look at our valuation, we're close to 40 billion, I think. And then you look at a Coinbase's valuation of 100 billion, right? So certainly there is a, opportunity for a Coinbase to move further into our space, right? But we're also looking at organically moving into their space, right? So it'll be interesting how it plays out. And that's why I smile, because obviously this is a game we play every day here. Who is looking at who, and who is probably going to be the next big mover in the industry.
I think on our side, look, we invested in ourselves in 2018 by launching LMAX Digital and trying to bring the two together. So that just happened organically. But look, we recently had a 30% investment by JC Flowers & Co, valuing us at $1 billion, which is a great valuation for us. Some people tell me it's undervalued in the crypto world, but I think we're just trying to keep it real. We're trying to focus on our exchange technology as what's really made that valuation worth what it is today. We got a physical amount of money for 30% of the company. And for us, that's just a starting point of where we're looking to take the exchange model with the FX and the crypto arm.
Craziest part to me, and I think Jay kind of highlighted this, is 5 years ago, everyone was thinking that the Wall Street was going to buy crypto companies. Wall Street's poor compared to crypto companies, right? Yep. If you look at how quickly this has been built, how significant the value accrual has been to these organizations, my thought process right now is over the next 5 years, many legacy institutions are going to be putting themselves up for sale. They're going to see innovation is going to disrupt their businesses, and they're basically going to try to extract whatever value they feel like they have left. And the natural buyer of those organizations would be the crypto companies. The crazy part is you're going to get what appears today to be two completely different worlds. The crypto companies will become more financialized, and these other companies will start to move more towards crypto. So they kind of end up in a similar place. The difference, though, is most legacy institutions, not all, but most, they actually don't have very good technology chops. They don't have the ability to kind of build new things and kind of innovate like this. And so if you are a legacy crypto business, and it sounds crazy to say legacy, right, when you're talking about crypto or an incumbent, you have a build or buy evaluation to make. And I just don't know how many of them are going to look at legacy Wall Street firms and say, oh, buying a 3,200 person sales force or relationship managers or that type of stuff is really attractive compared to, hey, we can build technology to do it. Now, it'll happen, but I do think that already the narrative has shifted from the legacy Wall Street folks buying crypto to now the crypto companies being in a much better position, kind of moving forward. Their balance sheets will continue to expand. They'll be able to continue to raise capital. And so, I don't know, it's just fascinating to watch this all play out.
But I think the combination of the two is really quite powerful, because you want crypto to look like a little bit like traditional capital markets, but you want there to be all the benefits that you get from the crypto world, the T settlement, trade on T and settle on T, not T+2. You can have your euros in a few days. It's the weekend. Of course, you can't have your euros. And then similarly, does that mean that capital markets can get better? Do we get 24/7 capital markets, traditional capital markets, as a result of what happens in crypto? I mean, we've even tried it. We launched LMAX Weekend FX last year. It trades small, but actually the crypto guys at the weekends, they're not just trading Bitcoin dollar, right? They're trading Bitcoin MEX. They're trading anything they can trade anywhere. around the world. And suddenly from a Friday evening through to a Sunday evening, they've got this Mexican exposure and they're like, what are we going to do here? So hopefully a bit of the two put together and we get to a better, happier place.
Absolutely.
Jay, I'm curious to get your opinion here, right? So we've got Pomp kind of on one end saying, hey, it looks like a lot of these crypto companies are going to acquire incumbents. Speaking as an incumbent today, what's your view on any pushback there? Do you agree, or what do you think?
No, because it's, historically, that's how it's always played out. You have, the incumbents that can't keep up, right, are the ones that get acquired. And the ones that are able to keep up are the ones that go out and acquiring. So there's really, there's no historic precedent that says one's going to play out over the other. And if you look at how the financial industry played out in the early and late 90s, when we went from dematerialization to electronification, it was kind of like a few firms popped up. You had the Instanets, the ITGs, the Liquidnets, and they popped up to compete with them. But most of these firms transformed themselves internally. If you look at Goldman Sachs in 1982 and Goldman Sachs in 2002, completely different firms. And they were able to create an electronic, platform that transformed him into a much different company that could compete with the electronified marketplaces. So I don't think there's going to be, I certainly think there will be acquisitions on both sides of the fence, but I don't think it's going to be, a complete, bloodbath for incumbents. And I don't believe it's going to be a complete, green field for the startups. The startups do have the luxury of great valuations right now and the ability to focus strictly on one end of the spectrum, which is crypto. We have the luxury of having an established business, and that's what the incumbents do, is they establish that business and they transform it. So I think it's going to be an interesting 3 to 5 years. That's for sure.
Yeah. It always is. And in crypto, that's the equivalent of like 20 years in the real world as well. So lots of time can pass. All right, here's my question. Like, let's game this out for 1 second. Let's say the Pomp, that scenario that you laid out, does ultimately come to pass. You've got more Coinbases, $100 billion valuation type companies, and they want to go shopping, right, in incumbent land. What exactly is it that they're buying, right? Are they buying companies with certain regulatory licenses? Are they buying a customer base? Are they buying assets? Are they buying, maybe some of them do want that sales force? If you had to say in your mind, like, what do you think they would be looking for if they went and acquired a bunch of incumbents?
All of the above.
Okay, all the above, fair.
I tend to think that's right. I mean, look at it. JP Morgan is a $480 billion company, right? Just use them as kind of a really, really large incumbent. They have brand, they have customers, they have assets, they have all this stuff. 400 billion sounds crazy until you think of a market dynamic that's at play. Before the tech industry, building a $10 million company, a small business, right, was a huge deal. And that was life-changing for people, et cetera. Then we went to $100 billion was that. Then all of a sudden, when the tech industry came along over the last decade or so, it became this whole idea of like, can you build a unicorn? There's like 20 unicorns a day now. Like literally $1 billion company is almost like you failed if you didn't do that, right? I'm exaggerating, but like it just becomes so pervasive. And so if you take somebody, there's a bunch of investors, maybe like somebody like a Keith Roboy, I think was probably one of the first ones that ever said it to me, where he was like, look, it's not about building $1 billion business, it's about building a $10 billion business. But I think what we're watching play out here is these technologies really allow for a much more global audience, and they allow for kind of network growth, which ends up meaning it's not going to be 10 billion. We're going to be talking about 100 billion is that new kind of barometer. Now, again, that might not happen for 3, 4, 5, 10 years, whatever it is, but like that's the direction we're headed. And so at the same time, stocks will grow and they'll kind of get bigger and bigger. But I just don't think that the equities can grow at nearly the rate that these other assets can grow, because you're basically repricing an entire kind of asset type or market. And so they just have the balance sheet and firepower to do it, right? When you start looking at that, it's really, really crazy. And so I think that ultimately you got to figure out how to fund this stuff, but that'll get figured out. And then what are you buying? Again, it goes back to my comment around most technology companies are buying either a product or they're buying a team. I don't know how enticing buying the legacy structured teams are going to be, just because it's been so much more reliant in many cases on non-tech. Now, there are some tech forward organizations, But when you see a technology company, I mean, take an AngelList, right? So something completely outside of crypto, but they basically wrote software and helped kind of redefine what venture capital was going to do. And they did it with, a small group of people and some software. That's what crypto is doing, right? How many of these organizations, one of the biggest complaints in crypto is they don't have customer service. You literally can't call anybody, right? There's nobody to email. And that's like a wild concept in the finance world. Now that'll actually change, right? That's like a perfect example where they will get customer service over time. And also the legacy players will start to use technology more to do more of that customer service. You get like a merging of the two. But I think that it's just really fascinating because when you break down the legacy businesses, I don't know, top 20% are interesting. The bottom 80%, it's kind of like survive or die. And what we know, and I think that Jay brought up a great point here, was around this idea of, there's plenty of firms that have navigated every technological advancement in history since their inception. So cell phone, internet, fax machine, beeper, all the crazy stuff, they'll be fine. But there's a lot of firms that exist today that didn't exist 50 years ago, and they're not going to exist 50 years from now. And that to me is a big thing. And the last thing I'll say, and then I'll shut up, is I also think a lot about like cannibalization of talent. So you almost eat away at some of the legacy institutions from the inside when their talent starts to leave to go to the new companies. So if all of a sudden, let's say you're a great technologist or a great trader, or you were super innovative or whatever inside of a legacy organization, if you're more intellectually drawn to the crypto world, you may not wait around for them to get in the game. You may just leave and go join a crypto company. And so you actually end up like seeing like an intellectual capital flight that is, it's hard to quantify, but it just feels like that's happening a little bit now. And so ultimately, I think what both these organizations are doing is the winning strategy. It's like, look, we don't want to rock the boat on our legacy business. We got a great business. It's obviously very valuable. Let's just, continue doing that and serving those customers in that way. But we sure as hell are going to be ready for this new world as well. And by the way, it's new today. So can we go be a leader in that world? Like we're a leader in the legacy world. Like the holy grail is be both, right? Like don't give up the legacy business for the new stuff, but also don't just ignore the new stuff because of legacy stuff. Like go be great at both. And I think, these organizations are doing that very well.
Yeah. We're running low on time here. So I just actually want to do one more round robin before we get to audience cues, which is that when you like look out into the future. So in 2017, right, it like made the news whenever it was like Bank of America is running a POC on blockchain, right? And that was like big news about institutional adoption. Now you actually do have like real funds and honestly organizations like State Street, like getting involved here. Like when you look 3 to 5 years in the future, what are some of the data points that you'll assess to how close are we to smushing that Venn diagram together? Is it going to be pensions are finally allocating to the space? Is it going to be virtually every incumbent, from banks, commercial banks to State Streets of the world, they support Bitcoin in some way, shape or form? Like what are the roadmap, like the I don't know. Yeah. What metrics are you going to use to look at this is moving forward, I guess?
So we actually run a survey this year, 200 institutional participants, and we asked pretty much the same thing. Who do you see coming to play crypto in the next 3 years? And 70% of those participants said asset managers and funds. And so I think we're aligned there. Once we start fixing the building blocks of the ecosystem, that, the whole ABC stuff that we discussed earlier. What is interesting and where we've seen the needle move is that 3 to 5 year mark that you talk about now is actually, if you step back to 2018 when we launched, that's your 3.5 year mark. We went to market because we created this concept of LMAX Digital. We said, okay, guys, 35 banks that trade FX with us today, you may as well take my crypto feed. You connect to me for FX, have this, it's our new product. Not one of them engaged. And it was a little bit scary because we'd done this big thing and we were like, oh yeah, because all the HFTs and all the prop shops want to trade crypto. The banks will too. Gave them they didn't even want to take the market data. Fast forward to 2021, a whole third of those 35 now take the market data. So we know the needle is moving. To try and say where we're going to be in the same time frame, I think a third of those will be trading it, not just taking the market data. And I actually anticipate that every one of them will be taking the market data in 3 to 5 years. So I think, it's, and by the way, back to what Pomp said, 3 to 5 years is 25 years, right? A lot can happen in that short amount of time. So I think that's why we see it, and that's the route we'll take on trying to sort of keep talking to these guys. Today, I know the majority of clients trading crypto is the private investor. Tomorrow, I think it's going to be the corporations, the banks, the funds, and I know that because I talk to them and you guys talk to them too, right? These are the people we're talking to because they're the guys of the future. You don't really necessarily need to talk to the underlying client who invest a couple of $100 in altcoins. That's not really what we're looking for today.
I think the critical data point, I don't think we've discussed here, is really payments of crypto. How does the payment and the use of a Bitcoin or other crypto payments finally fulfill its use case, which is to facilitate a global payment system? And right now there's a very finite group of companies that are participating in that, and how that ecosystem plays out will obviously snowball into the asset management space. So, the two data points I would say, okay, how does that payments play out for crypto, and how do asset managers follow that? But I think that has to be the first piece of it.
Pomp, anything to add?
I nailed it. I'm speechless for the first time.
All right, cool guys. Let's transition. That was really that's kind of the end of our regular conversation portion. I want to transition into audience Q&A here because we've got a bunch of really good questions. So this one's actually for Jay specifically. So I guess it would be great. Like I'm very familiar with State Street's business, is like what you kind of do for large asset managers, funds, issuers, et cetera. I guess a question would be, what sort of other crypto firms are you working for? Like, how would you work with kind of an LMAX? And maybe you already are working together, and I should know that. But that's kind of the question posed to you.
So, we see LMAX as a destination like anything else as we start to evolve this ecosystem. So, if you look at how the crypto business has played out, it's all started with custody and then trading followed. We see it developing the same way. Custody is critical for us to build. Administering those funds, being able to administer those funds will be probably the second piece. And then trading, working with an LMAX or any other liquidity provider to satiate that institutional liquidity will probably be the third piece. Will it exactly go in that order? No, because this is a very unique type of, it's a hexagon. It's not linear, right? So being able to facilitate institutional liquidity, and that's part of our front to back office strategy. We have the front office with CRD and Alpha in order to get ideation and execution, and then we have the middle and back office to service and facilitate those assets. So it's we see ourselves working with whatever could help facilitate and benefit our customers.
I think just from my side to add to that, we welcome the traditional custodians to play this role. We just want to run exchanges. And when a fund comes to me and says, I need to store my assets at State Street, great, do that. Let me allow you to execute. I'll match a buyer and a seller on the exchange. I'll then settle to your custodian. That for us is the dream. We don't really want to play that role. It's just happened to be that as we started looking in 2017, wasn't really much of an option. We had to go build the custodian service because as you look to onboard only institutions, you're not talking about a few $1 million, you're talking hundreds of millions and billions of dollars under management. So, it's an issue and bring it on.
Yeah. Pomp, this one's for you, and I'm paraphrasing a little bit here, but when you think about institutions coming in, one narrative that's kind of existed for a long time is that as more institutional players move into this space, that volatility is going to dampen because they buy for the long term, have stronger hands, so to speak, et cetera. I'm curious, do you agree with that narrative? If yes, why? If no, why, et cetera?
Short answer is I don't know. Right. I think that's kind of the truth. In terms of if I had to guess right now, the asset is going to become less volatile for three reasons. One, the more people that hold it, forget institutions for a second, like just the more people who hold it, the more decentralized it gets, the more it will become kind of tempered. There's also a time component to that as well. Like the longer it's around, the less people are like, oh, this is new, what's it worth? And the world has kind of priced it. So I think that's kind of a key market structure. The second thing is you're going to get like a wave almost through the industry. So first it's going to start with Bitcoin, the volatility and returns, because volatility works in both ways, will kind of temper. Then you'll get Ether. Then you'll get, and it'll just work its way through kind of like a coin market cap list. So right now you had Bitcoin used to be hyper volatile and all this stuff. Now it's started to temper a little bit, even though it doesn't maybe feel that way. It's definitely less volatile today than it used to be. But these things on the other end of the spectrum, they're super volatile. Well, eventually those things won't be as volatile, and then there'll be new things on the edge of kind of innovation. They'll be super volatile. So you kind of just like move through the industry. And the third thing is you got to be careful with institutions. Like I know the thought process is like, oh, the institutions came in and they're going to be the ones to hold. Well, like kind of, but like Tesla was out here selling 10%, testing liquidity, and like that didn't, really help us, for a little bit there. And so I think one of the big tests, and I don't know the answer to this, but to me, this is like the $1 trillion question in the short term is, do we get another 80% market drawdown after the finishing of the bull market through Q4 of this year? I can see arguments for both. Yes, an 80% drawdown, or no, maybe there's a 20% drawdown, but it's not quite as severe. And to me, the answer lies with the institutions. All these institutions, and I count institutions as financial institutions, corporations, and also nation states. Do they hold if it drops? Do they basically say, I'm actually willing to ride the volatility? Because it's one thing in the traditional world, I think, where people say, hey, I'll hold volatility. And the volatility, I always joke in the stock market, stocks go down 3%, everyone's like yelling and screaming like the world's ending, right? And in Bitcoin or in the crypto markets, what happens if they see another 40% drop in a 2 or 3 day period? Do they hold? Do they panic? Do they like? My guess is they're going to hold. Right. And so you may still get pretty significant drops, but I just don't think they're in the business of like day trading the assets, but they may size it differently if they think that volatility is coming. So ultimately, like, yes, it will dampen, but I don't think it's just, institutions are in the market now. I think there's other things at play as well. And then the last thing I'll say is like the dollar's super volatile, right? Like you've been a moron if you've been holding dollars for the last year. 38% of dollars in circulation were created in 18 months. Like it has been really volatile. The difference though is that all of the goods and assets around us are priced in dollars. So we don't see the volatility nearly as much. And so if all of a sudden things started to get, whether it's Bitcoin or some other crypto asset, if everything started to get priced in those assets, you wouldn't see volatility. Your purchasing power would be the thing that you would have to measure because everything is priced in that asset. And so I think that's one of the big things that we forget is like comparing Bitcoin and the dollar to each other. Bitcoin and the dollar both have purchasing power and they're relative to each other. And so it's not a new concept around this volatility. It's just that we see it because everything's priced in dollars and we're holding these other assets.
Yeah. I guess, you mentioned kind of coin market cap there. And one thing that we haven't really talked about, we've assumed a lot of this conversation falls around Bitcoin and certainly probably will. But, one other narrative is kind of that, as institutions move in, the vast majority buy Bitcoin, right? Maybe some of them get Ether too. I think one kind of interesting thing is the relative outperformance of ETH versus Bitcoin over the course of the last couple of months. I talked to institutions probably less than everyone on this call, but what I have heard is that there's more and more interest in Ether. And what my curiosity would be is, as you see institutions, we've talked about different types of institutions, what they need to move in, what are they going to be interested in buying? Do you think is the vast majority still going to go to Bitcoin? Is it going to be Bitcoin ETH? Are they going to want to move out along the risk spectrum? Like what do you think these institutions might buy? Yeah, you smiled again, man. You bring this on yourself.
No, it depends. I mean, for us, it's funny because people always ask me when I speak to them, hey, do you think anything's going up or down? What should we buy? And I never answer that question. So that's why I'm smiling. But I think it really depends on what you believe the use case is, right? So, if Bitcoin's use case and Ethereum's use case are two different use cases. And it's less about, the cryptocurrency and more about, what's going to facilitate their portfolio model. And the reason I smiled was the ESG piece is preeminent in the asset management world right now. So understanding how, ESG investors are going to, enter the crypto market, it's going to be very interesting because I can make the argument of both sides of ESG that Bitcoin is ESG friendly, and I can make the argument that it's not. And I could do that with any other asset. So it really, that the ESG piece is the one thing I think that's going to be a critical decision point for a lot of these asset managers.
Yeah, and I think to add, I speak to a lot of broker clients at the moment who are basically saying to me, I can do a lot more if you offer me everything down the coin market cap list. And I'm like, okay, it's not really what we do. We'll see if we can add any value there. But we know it doesn't actually trade that much. We know the order books are not as liquid as they are in Bitcoin and Ethereum. And actually in New York at the event last week, I spoke to a bank and I was like, so what are your thoughts and what do you need to trade? And they will be one of the first to trade. And They were like, who trades anything but Bitcoin and Ethereum? So I think in answer to your question, we're probably, from a banking perspective anyway, I think we're good on Bitcoin and Ethereum for now.
What about you? What do you think?
Yeah, I tend to think Bitcoin and Ether are like the institutional interest, like that's where they're interested. Here's what I'll say is it goes back to, are you trying to trade or are you trying to build? Right. And like, there's like this building aspect of, if you want to build, you can build stuff around Bitcoin. While we were on the call, Twitter, announced that they are doing Bitcoin Lightning Network tipping. They're going to integrate it into Twitter. But that's a very much like a builder's mentality, very much like, let's integrate technology, let's build technology. There's a lot of folks on Wall Street, they just want to trade, right? I always joke about the story of some of the best traders in the world. They sit down in front of the screen, they don't even care what the asset is. Just show me the charts and I'll start trading, right? And so like you really, I think, got to kind of separate out those two groups. With that said, Bitcoin and Ether are there today because they have liquidity and legitimacy. These other assets are going to get liquidity and legitimacy over time as well, right? So it's less a matter of like, are they going to trade other stuff? Are they going to participate in other studies? When do they do it? And I think that some of it is, what's the next Bitcoin? Like we used to joke about that question. And it's less about like something's going to replace Bitcoin now. And it's more about, where do I get the returns that the early Bitcoin investors got? And so I just got to go further and further out on the risk curve, the newer stuff. And that's where the return's going to be.
Yeah. I can't remember who said this anymore, but there's like this quote about chasing the next Amazon, where it's like all those investors that tried to chase the next Amazon, they would have been better to just buy Amazon the whole time. I don't know if that analogy applies here, but it did remind me of that. All right, guys, we've got time for one more question. So I guess super quick here. So I guess talk to me about scale. I know Jenna, David has mentioned this before, but when you see like amounts of institutional capital kind of flowing in, let's assume the best case scenario, right? And pensions and sovereign wealth funds and other large forms of institutional capital are like, I want to make some move into this space, right? What could we be seeing in terms of numbers here, right? Like how much capital are we talking about moving into this space?
I think when you think about pension funds, just a 5 to 10% allocation equals sort of tens, if not $100 trillion in the market. And that's a huge uplift from where we are today, right? It's still small relative to what we're used to in FX, $7 trillion a day traded, but it's huge. I mean, today I speak to funds who, the bigger ones that I face might have 100 million. We're just not there yet. So there's room to grow, it's getting there. It's just about these guys putting that allocation into crypto that's just going to change the dynamics.
Yeah. Pomp or Jay, any closing remarks there? 2 minutes we have left.
No, I think that's a critical piece is how much money is going to move into it and what's the reason. There has to be a reason behind entering a market as opposed to just entering a market. And I think the real use case in the investment ideation is going to be critical.
All right.
I think Bitcoin's going to 100,000 or $100 trillion asset over time. So it'll take a while to get there, but it's going there. And I think that many of these other networks are going to get quite large as well. And so I'll leave you with this, which is, the most valuable technologies in the world are market expanding technologies. If you looked at the data center business and you said to yourself, how big could Amazon AWS business get? And you just evaluated total addressable market at the time, and you looked at it from a market penetration, you'd come up with an answer. Well, what happened was Amazon's AWS actually handed the ability to create more and more traffic and websites, et cetera. And so it expanded the market. Uber, if you had evaluated that early and you'd looked at it and just said, oh, look, how big is the taxi industry? Well, if they capture 2% of the taxi industry, that's how big they'll be. No, they ended up expanding past that. Now there's people who literally don't own cars because they only use Uber. And I think that this industry is the exact same. If you look at the financial market today and you measure it, however you want to measure it, by assets, market caps, whatever, it will look like peanuts when this is all said and done from this new industry. The hard part is which assets accrue the most value and which assets end up being the best place for people to go put capital. And I think that's what ultimately, when you're LMAX or State Street, et cetera, it's like, look, we don't want to be in the game of selecting. We want to be in the game of, let's just help people get in the market. Let's support them. Let's serve our customers. But I think that ultimately is the really exciting part, is if, you see this underway, you don't get many shots at this. I remember kind of starting my career and saying, damn, I wish that I had been around in the 90s on Wall Street or in the 2000s in Silicon Valley. Right. And we basically waited another 20 years and here we go. So I think that people just got to, have a little courage and conviction to participate and do it with great partners, and then you'll be in good shape.
Absolutely. Well said. All right, team, that's all the time we have. Thank you guys so much. This has been a really, really great conversation, and a big thank you to Jenna and David and the entire team at LMAX for making this possible. Thank you guys so much. Again, if you're an institution, you're trading in this space, I highly recommend you go check them out at lmaxdigital.com. And again, if folks on the audience are still listening, like this, the next episode that we're hosting is coming up on the 28th. We're going to be talking about the DeFi mullet. So that's the future of DeFi and FinTech integrating. And that's going to be Ostani Kulichov of Aave, Jonathan Anastasia of MasterCard, and Michael Shalov of Fireblocks. So guys, thank you so much for the time. This has been a fascinating conversation. I'll have to do it again soon.